Hey, everybody. Welcome to the morning market briefing Monday. Big day, guys. 7-Eleven.
Woo! Get your Slurpees in now.
It's gas day. Hope you guys are doing well. Hope you had a good weekend. We do have, are we doing a call tomorrow? No call tomorrow? No call tomorrow. No call on Tuesday because we have the macro tomorrow afternoon. If you have questions on how to attend or how to watch, shoot us an email. But we'll be kicking off the macro tomorrow afternoon around 4:45 probably. And getting rolling there. It will be at Third Door here off of Marietta Square. It's where we've had the last couple. So if you've come before, do the same thing again. We'll have cocktails and commentary and all that good stuff. But let's jump into today's call. Elon Musk walking away from the Twitter deal, a bit of a Friday afternoon news dump. Both teams really lawyering up, trying to figure out how to make the other one pay for this. Musk doesn't want to pay anything, says he was scammed. Twitter wants him to pay $1 billion breakup fee. Ben, how's this going to play out? It's kind of an ugly situation.
Yeah, I think the consensus is that Twitter has the legal argument, but there's no real leverage behind it. So the maximum that Twitter could, the breakup fee is $1 billion, but that's only triggered under things like debt financing falling through or regulators actually trying to block the deal due to antitrust. So he's not going to pay the breakup fee. What Twitter could do is they could sue Elon Musk for failing to go through with the deal. But again, that they can only sue for up to a maximum of $1 billion. So the market cap lost relative to the deal value was far more, 10 to 20x that $1 billion. So the question then is, what do you do? How do you actually get Elon Musk to pay what he owes? And there isn't really a ton of precedent for that. You can't really force him to buy the company. You're going to send him to jail for that. So there's huge question marks there. Again, the legal authorities that say that Twitter has the better case, but that they can't really do anything about it. There's no teeth there.
It also seems like an odd position to be in if you're Twitter, even if you said, hey, they've got completely solid ground to stand on. There's a degree to which I would wonder how much you want to poke the bear. I mean, clearly Elon's issue, at least is publicly portrayed as the fake user issue, which would have serious ramifications, I would think, as it relates to fraud on SEC filings, commentary, guidance given, any kind of investor presentation. If his motive all along was try to kind of shake these trees, and either by buying the company and seeing what falls out, or to just get a little bit of progress in terms of what he views as a lack of open commentary on Twitter. If that's his agenda, I would be very worried if I were Twitter and I was sitting on a fake user problem. I don't know that I want to go after him too hard. Tom, you got any thoughts?
I mean, it's basically like you walk onto a car lot, you look at a car and say, hey, I really like this car. I'd like to buy it. Can I take it to my mechanic and have a look at it? And the mechanic says, there's no engine in here. There's just 3 squirrels. And then you take it back. I mean, he doesn't have to buy it. There's no gun to his head. I think also, in terms of the market cap, when he first made the initial offer, they paid Goldman Sachs to say, hey, this thing's actually worth $60 billion. So they can't really come after him on that because they're like, well, even if we lose the market cap, they can't blame him. Theoretically, it's supposed to be worth even more than he offered per their actual words. So, I mean, I think Twitter is, they're just going to have to take this one on the chin, and it's going to be tough for people who are trying to play that arbitrage. It's going to be great for people who are shorting that. We talked about a little bit on the call. Why is it not going straight to the trade price or the purchase price? And the reason for that is there are people shorting it who assume that this would not go through, and those people are going to be taking a victory lap today.
Twitter's a perfect case study, and there's a saying for it, but I'll use the more G-rated version of it, and it's never fibber. Yeah. And that's exactly what is happening right now. I mean, Elon Musk knows the game, and he basically is calling Twitter on his bluff.
Yeah.
Don't fibber.
Caveat emptor, as they say in Latin. Buyer beware.
Ben, we are seeing some prices fall in a couple of areas. We're seeing freight costs improve a little bit. Cruise travel, maybe not all that surprisingly, is becoming quite cheap. Do you have optimism that could be positive for kind of the inflationary trends? And what are you seeing kind of in these pockets of the economy?
Yeah, I think that we're starting to see some of those inflationary forces start to decline. Freight costs coming down 15 to 20%. It's still higher than pre-pandemic, but on a rate of change basis, that's really positive. So that's moving down in the right direction. That's due to demand. I mean, I'm not going to say that this is great news because the economy is still firing on all cylinders and inflation's coming down. No, it's coming down because demand is coming down. So freight costs coming down quite a bit. Cruise travel is getting, there was a quote in Bloomberg this morning that said it's cheaper than a Motel 6. 2,000 cruises are on market right now that cost less than $100 a day. There are 53 cruises that cost less than $50 a day. Disney just offered deals of up to 35% on some of its fares. Disney just does not do that usually. And the question is, why is this happening? Because we thought the cruises were all booked out into 2023. And the reason is people still have concerns about pandemic, the vaccination and testing requirements. But I think the thing that the article didn't talk about, which I would contend, is that at the end of the day, people don't have the discretionary income to go ahead and do that, especially the people who would then generally do cruises.
$50 a day, man. I don't know. I might be a cruise guy.
Well, I read an article a couple weeks ago saying that long-term hotels, like extended stay hotels in Atlanta, were like 60% booked because people couldn't afford rent. I mean, you could live on a boat. You know,
I mean,
it'd
it's
be a
not
lot.
the worst.
$50 a day is probably cheaper than what it costs to stay in a lot of extended stay motels right now. So you can just go enjoy the ocean.
Work remotely.
Yeah. If it's all inclusive, I mean, that'd be great. You know, food, housing covered, $50 a day. See
Yeah.
the sights.
I mean, the next time a young client comes to me that works from home and says, I'm tired of paying rent, I want to buy a house, I'm going to say, tough luck, buddy. You're going on a cruise ship.
Yeah. We'll see you in August.
The lower quintiles of the population are really getting hammered.
Yeah.
They're getting hammered really badly with the inflation piece, and they haven't even lost their jobs yet.
Yeah.
Wait till the job losses come in.
But wait, there's more.
I mean, coming and going. I mean, we saw the wage or the gap in wealth accelerate when we were at zero interest rates, and now that we're hiking interest rates, we're seeing it exacerbated going the other way. I mean, it's a double-edged sword, and they're getting caught both ways.
There was one article in Barron's over the weekend about car repossessions, saying there are a lot of cars being repossessed right now. About 4% of is the repossession rate on prime loans, and versus 2% is the norm, and that's on prime. Some interesting facts that were brought up in the article included that most of the loans on recently repossessed cars were originated during 2020 and 2021. So this is not just kind of a random normal distribution of dates of when these loans were originated. It's just it's really in 2020 and 2021. And the loan to values are around 140% versus a mere normal 80%. So basically, this is the same situation we had in 2008, where people said their home was not worth what their mortgage was. They just walked away. And that's what a lot of people are doing on their cars. They their loan is so much more than the value of the actual the vehicle. They're just walking away from the vehicles and allowing them to be repossessed. A lot of these people never made a single payment. There was one guy who was interviewed for the article. His name is great.
Lucky Lopez.
Lucky Lopez was interviewed for the article, and he said he recently bought a Bentley, McLaren, and 2 Aston Martins, all purchased by buyers using PPP money as down payments. All were repossessed after few or no monthly payments. He said that he's never seen so many people making $2,500 a month, owing $1,000 a month in car payments. Basically, these people's incomes were inflated. There was this rush to buy a vehicle during the pandemic, and they can't afford them.
We got to get Lucky Lopez on the Fed. I mean, I love this quote, the idea that the economy is strong, ? Anyone who's actually doing business sees things are not strong. We got to get this guy elevated. Ben, do you think there's a big risk? How big of a factor do you think this could be as it relates to the economy as a whole? We've talked about the 2008 housing issue, but do you think this is on that scale?
I don't think it's systemic. I think that you have some banks who got fairly aggressive on auto loans, but other banks did not. Wells Fargo is probably among the most aggressive on the auto loans, but that's because they're really trying to ramp up their loans. So I'd expect them to see some issues as a result of this. You also have the car manufacturers, a lot of them who originate some of these leases and loans. They will be on the hook for it as well. So I think that you're going to have some consequences there, but I don't think it's going to be systemic like you saw the financial crisis with the housing piece, because the asset value is so much different. Having said that, I do think it's a significant sign of the weak consumer and the stress that the current consumer is having, because they obviously took on more spending than they could pay for. And especially now you're seeing so many products sold on subscription, sold with using Afterpay, or even the iPhone that's purchased, you're spending $30 a month. There's hidden liabilities, off balance sheet liabilities, if you will, on many consumer balance sheets that are easily assumed, but it's very difficult to actually pay that off. And you're seeing it in the cars, and I wouldn't be surprised if we see it elsewhere too.
And the car space in general, I mean, we've got a client that's very tied in with the automobile space. And I remember talking with him, and he talked about just the evolution he's seen in car loans. He said, ultimately, when someone comes in to buy a car, whether it's a sedan, an SUV, a pickup truck, they anchor to a monthly payment amount. And he said it used to be that the most common car loan you saw was 36 months, every once in a while, one that was 48 months. So going out 4 years. He's like, we've got tons of people coming in that want the monthly payment that they want. So they're going out to, 84 months, doing a 7-year car note. And he was like, at the end of the day, like, we can't really keep them from doing that. But the read through is they're buying more vehicle than they actually have the purchasing power to do. They're extending this out more than twice as long as people used to, just to make that monthly payment work. I mean, it's the equivalent of saying, well, hey, I'm buying this massive house. It's more than I need, but I'm going to do a 60-year mortgage on it. I mean, it just doesn't make sense to a certain degree. So I think that's probably an area that was probably has been ripening for some time. I mean, that was a conversation we had several years ago.
Especially these large payments on depreciating assets.
Yeah, the thing is, like, your house could eventually go up in value, but the car is not.
It's not
Functionally not.
And I think that's the big issue. I mean, your iPhone isn't.
Yeah.
Your iPhone's going to go down in value. So there are a lot of these areas in the economy where people have these monthly spending and buying furniture. You can pay for this furniture over the course of 3 years. It's just not going to, it's not going to end well. And unfortunately, a lot of these people have a lifestyle that they can't really support.
I think that's one of the most fundamental breakdowns in society, is that people they lever up to buy stuff. If you're levering up, you should be buying assets. I mean, that's how Blackstone makes its money, right? They put down 3% on an apartment building, pay the interest for a couple of years, and then sell it for 3 times what it's worth. But they only committed 3% of the capital. Whereas, like, you buy a car for 140% of what it's really worth, you lever it up for 8 years, and then when you pay 3.5 times what the car is actually worth over the life of that loan, you have nothing. You basically paid 200 or 300% of what it actually costs, and at the end of the day, you had zero.
Interesting week ahead. We got Pepsi earnings tomorrow. We get the macro. Wednesday we have CPI, beige book 10-year auction. Thursday PPI. We'll get JP Morgan earnings in the morning on Thursday. So we'll start to get the banks rolling through. Friday we'll get retail sales. We'll hear from United Health, BlackRock, and others. Kicking up earnings season. How important do you think the CPI number is this week in this grand scheme of things?
I think in the long term, it's probably not as important. I don't think it's as important as the last one. Ben and I talked about this a little bit before the call, which is that, you're starting to see the cracks in inflation, but this number is going to read a month back, right? So if we peaked theoretically last month, then this will be the highest number. And I think the market is smart enough to know that. I think we're already seeing that a little bit. Ben said his exact quote was a bigger fish to fry, which is the fact that we're probably going to print into a recession as well. And we've got additional rate hikes on the horizon. It's not going to be the be all end all, I think, that it was last time.
If it comes down some, though, does that give the market some optimism?
I think it does. It may affect the number of rate hikes we get. I think growth will probably look very good that day. Whether or not it sticks is tough to say, but I mean, I'd be interested to hear Ben's thoughts on it. What the long-term ramifications of, I mean, if we come in at 8.2 and the expectation is 8.8, I mean, that could be a very green day, both for stocks and bonds.
Which I don't expect, by the way.
I think it's unlikely. I think we'll probably see peak inflation this month, but next month will probably be stronger.
Yeah, I would echo everything that's been said. I think that this probably means a little bit less. I think there will be a lot of focus on it, given what has happened and what has transpired. But again, I think that the big thing going now is going to be, what does this recession look like and how quickly can we pull out of it? Because we're in a dive right now. And the question is, can we pull out of the dive before we hit the ground?
Awesome. We'll wrap it up there. No call tomorrow. No call on Tuesday. We will have the macro presentation tomorrow afternoon. Hope to see you guys there, and we'll talk to you guys soon.